base. Please bear with me in case my handwriting is not very good, but I'm trying my level best. So this is B, this is the E, this is the P, this is S. So what does mean? Base, which base? Tax. Which base? Tax base. Because if tax is applicable in country A, in A, if tax is applicable in country A, on what? Profit. In country A, tax rate is 20%. Here I'm putting the percentage just for the illustrative purpose, understanding purpose. Tax A. And here is the another country is B. Let's take the UAE. How much the tax rate? 9%. Tax base, what is the tax base? Profit. Let's assume the profit is 1 million. If we pay the tax in country A, how much it will be? How much will be tax? Please give me the calculation. I appreciate your active participation. Give me the figures. $200,000 because 20%, and here 9%. How much will be here in 9% in country B? Now, if the business in country A, business operating, I'm gonna the word use the operating in a country A, because here tax rate is at 20%, and they don't want to pay 20%. So what they gonna do that? They see another country, the country B, where the tax rate is a 9%. Let's say in UK is 19% and UE is 9%. So the people or the businessmen or the management, they do the transaction to increase the cost in country A. So at the end, this profit will be only the 100,000 after this. Okay. What they did, they increase the cost in country A and they reduce the profit. So let me, if the cost is increased, so profit is reduced. Now the profit in this after this in country A maybe is 100,000. So how much the tax over here? How much tax over here? 20,000. Because now they are doing the base shifting to another country. So let's assume that so here the profit before in this, what are the business vehicle they will use? That is the additional topic. So here the profit is 100 is here 900. So how much the tax? How much the tax over here now? So now you understand the difference. If he earn the 1 million in country A, then he's gonna pay 20%. And if the same 1 million is earned in country B, he's pay the 90,000. But here we assuming that this profit is belongs to this country. 1 million initially was here, and then what they did, this shifted over here, and at the end here is only 100,000. So what they did is they shift the base from country A to country B, and how much the tax they save. How much the tax they save. Other participant, please, how much the tax they save. I appreciate if you are active and you have the calculator with you, copy pen with you, then we are able in a good track. Other participant. Hope the base region shifting understanding is clear. Hope the base region shifting concept is clear now. I'm audible? Okay. Now let's okay, we are here now. We are this one we already discussed. This one we already discussed. Okay. Hope the BEPS is clear now. Now the next is the interest expense. So what is the law allow us higher of? Law allow us higher of what? Law allowed higher of 30% of adjusted EBITDA. And previously we learned the adjusted EBITDA. Why we learned, so hope you are understand why we learned the adjusted EBITDA definition. Now it's making the framework, making the integration in your mind, what we are learning, in which parameter we are learning and why we are learning. So gradually you will have the complete integration while coming to the return. 30% of the adjusted EBITDA, and now we mentioned EBITDA cannot be less than zero. If we have the tax losses, EBITDA will be considered as a zero. So what is the minimum safe harbor for the tax deduction that is all companies have it is 12 million. So this 12 million If our EBITDA is less than 0, we can utilize the 12 million. Why? Because higher of, if 30% EBITDA is higher than 12 million, then he can have the maybe a 14 million, 15 million, whatever, but depends on the scenario. Another important part, the net interest expense. What does this mean by net interest expense? What is the means? This term is very important. But the term net interest expense, I appreciate if you can clarify your understanding. Because when we are calculating, we have to go in the same fashion. What is the net interest expense? Net interest expense means if we have the, let's say that 10 is the interest expense and 2 is the interest income. 2 is the interest income. So this will be 8. This will be 8. So this is what, when we are counting how much, this is the allowed. Net interest, because we have the income and expenses. Yes, no more. So this is the net interest expense definition, net of income plus minus income and expense. And there is another term we use, the TCI, total comprehensive income. We will use onward also. One, we use the profit before tax. Second, that is second last item. And what is the last item? This is the last item of the profit and loss, financial statement. TCI, total comprehensive income. It have the meaning, it have the definition. If we understand, then we are doing the adjustment appropriately. Now the interest capping rule, which ministerial decision is dealing with that? Which ministerial decision is dealing with that? Anybody can share on that? Anyone can share which ministerial decision is dealing with the interest capping rule? Guys, I appreciate your quick response. Even you are not knowing, so please give the answer. Which ministerial decision is dealing with that? Which ministerial decision? Quickly, yes or no, or give your understanding. See, in the learning, same quiz will be there, same understanding will be there. Adif, meanwhile, you have the quiz for the day. So please share the link for the quiz also, but we'll continue and later on we will work on that. Only the link and the code, joining code will share later on. Okay, the ministerial decision 126 is dealing with the interest limitation rule. You can, guys, you can search on the Google. Although here I already added, if you want, I can share because while working, preparing the data, so we are adding the relevant link also. But let me see if I can share in the WhatsApp. This screen will not be appeared to you, but but Okay, guys, you can see my screen. Okay, you're fine. So this is the ministerial decision. I link is already shared. So now we can, Atif, we can go with the sequence, no? 1 by 2, 2 by 2, or something like that. From the day first, you can continue. I think 4 or up to 5 quiz we completed, and then we can continue from there. Okay, the ministerial decision number 126. Why I added over here the screenshot for our learning today. Accounting earning before interest expense. Again, the word EBITDA. And the second, the point what we are learning, the EBITDA for tax period shall be greater than 0. It cannot be minus. We discuss taxable income in accordance with the Article 20. With Article 20. So here the complete understanding is there, but we understand on that also. So let's take the example for our understanding to understand what is the interest capping rule. What is the interest capping rule? Let's take the first example. If the EBITDA is 100 million, if the EBITDA is 100 million, net interest expense is 35 million. Now the net interest is the net interest how much? 35 million. So how we calculate now? What we have to calculate? Interest capping rule. How we will apply? What is the rule? Interest capping rule. Higher of option A, 30% of EBITDA. So let me know what is the this amount. So what is the EBITDA? 100 million. So make the 30%. So here 100 million into 30%. Give me the figure. Give me the figure. Only few participants are active. If we take the 30% is 30 million EBITDA. Now the second, what is the second? The rule is higher of 30% of the EBITDA at 12 million. What is the 12 million? As per law, minimum safe harbor. Law is saying minimum this much is allowed, but if you want to take the higher, then this is the rule you have to test. This is the test you have to apply. So now what is the interest capping rule? Interest deduction limitation. What is the interest deduction limitation? What is the interest deduction limit? So here is saying interest expense, how much? This is the interest expense. This is the interest expense. So how much is allowed? Guys, how much is allowed? Uh, how much is allowed? From this amount, we have to make the split. How much is allowed? Let's assume this is the 24 and this is the 25. And this figures belongs to financial year 24. How much figure we can report in 24 and how much in 25? Other participant, quickly please reply, quickly please response. If we are considering 30 million is allowed for the 30 million allowed for 24 and 5 million carry forward for the next 10 years. So this is the rule of the interest capping rule. First we understand the EBITDA. Then we understand, okay, 30 million, because the interest capping rule apply up to 30 million is deductible and balance will be the 5 million will be carry forward for the next 10 year. So this will be deferred tax asset or no? This 5 million will give you deferred tax asset or no? Adjusted beta exempt, what are the element to be covered? Is it is a beta exempt income exclude Article 23 from the beta figure after making 8 adjustment into accounting profit. Means first we will do computation of taxable income as per applicable city law. Then after transfer pricing adjustment if applicable. So today beginning we understand what is the adjusted EBITDA in detail. At the adjusted EBITDA amount of 12 million for 12-month periods. Now here the if a portion, here what is our learning? If our accounting period or tax period, now we are assuming both are same. If accounting period is 6 months, tax period will be 6 months. So then this 12 million will be split as per the accounting period. The diminutive limit must be adjusted proportionately for the tax period. This is another if due to any reason it FIFO basis has not, this is FIFO basis. If the our accounting period increase, it will be more than or less than 12 months. So according to 12 million will be a portion. Okay, next example two. Now this next example two. I due to this handwritten, I think is not able to visible. Let me do something. Let me do something because I saved actually. Okay, welcome back, and we're gonna start again with the same. So let's continue the same example and understand example two, year one. Profit before tax and disallowed interest expense. Uh, this is the not internet, this is the interest. Okay. This 5 million coming from where? This is the same 5 million carry forward in year one. What is year one? After this, next 10 years. So this is the year one. Came from the, if it's zero, here we can say the year zero and this is year one. So how we will calculate now? How we will calculate this? If EBITDA is a if EBITDA is 100 million and net interest expense for the year two is a 28 million, And BD interest expense is a 5 million. When we are discussing the adjusted EBITDA, so please understand now. So how we gonna do that? So 28 million, we will apply the 100 million. Again, the same 100 million into 30% is a 30. So which means is still higher than the interest expense for the year. How? Because here is coming 30. But how much the interest for this year? 28. Means 2 million limit still available if we go still on that point of view. But how it will be? They said 28 is for the year 2 plus the BD interest. Plus the BD interest. So total how much? 33. So now here will be like this. So now how much is allowed? Up to 30. Up to 30 is allowed. So how much disallowed that will be carry forward is a 3 million. But on which basis? Just now one of the participant is mentioned on which basis. Basis mean what is the rule? Basis mean FIFO or LIFO. So this means how much element from this 5 million will be carried forward or 28 million will be carried forward. So which means the first, while deducting, we have the limit up to 30 million, right? So this 30 million, how it will be? This 30 million, first it will come the 5 million. Which 5 million? This 5 million. And balance 25. So 25 will come from here. 3 million from 28 millions. So this, so 28 minus 25 is 3 million. So this is the 3 million that will be carried forward. Why it carry forward? Again, this will be 10 year starting from this. Otherwise, first interest we already utilized. So again, 10-year rule is available for this 3 million. Hope this is the understanding is clear. Hope this point is also clear. Hope this example is sufficient for the understanding of the concept. I'm just reminding you, this is not the we are final comprehensive topic. Still, we are not discussing the comprehensive topic. That once we come one by one to each topic, you will have the more understanding on that. Here is something is this we already discussed is coming from here. Okay, anyhow, come to the sorry, the another rule here. The point is missing the current year. The FIFO rule is have the additional understanding that we're gonna discuss on that. But the first rule, what is the first rule? First, we have to utilize this 28 million in a current period. The current year expense first will be utilized against 30 million. The FIFO rule, the first will be utilized. Then after this, we have to see what is the brought forward. Brought forward means if we have the 5 million from 2023, let's see, and the 5 million from 2024. So which 5 million, from which 5 million, the balance 2 million can be utilized from this. And balance 3 million will be carry forward. 5 million brought forward. Here we have the year one, 5 million. From this, we utilize only the 2 million because 28 million of the current year we utilized and balance limit is only 2 million that is utilized from the brought forward and balance 3 million carry forward to third year for the future. The definition of the FIFO applicable from here. First is 23, then 24, then 25. But the current year expense must be settled first. If the limit is available, then we can adjust the brought forward. If no, then whole amount will be carried forward. Example 3. Net interest expense is 18 million. Would you please do the calculation so far considering the previous brought forward? Would you please do the calculation? Would you please, considering the same example, same continuity, guys, would you continue here? Irtada. Okay. Any other? Anyone else? See here, you have to mention how much for the under example, how much will be from the current and how much is the brought forward. Give the breakup. Here the total limit is a 30 million. Our interest expense for the year is 18 million. So which means we have 12 million gap that can be utilized from the previous year. But from previous year, we have only 3 million. Let's move to the next example. Hope this point is clear. Example 4, 100 million. Now the net interest expense is 8 million. Next example, EBITDA is 100 million. Yes, because 8 million is less than minimum safe harbor. That is a 12 million. So even we don't have to do this calculation test. Because why, at what stage or in which corporate tax return we have to do this test where the interest expense is higher than 12 million. Either the current year or either the brought forward together is higher than 12 million. Yes, we need do this test. But in all the cases, adjusted EBITDA will be calculated and reported in the city return. No need to test the interest capping rule. Now again, here emphasizing 30% EBITDA excluding the exempt income, whichever is allowable expense under the city. Why we are focusing exempt income? Because the adjusted EBITDA calculation, how it will be calculated, we have to exclude the exempt income also while doing this test. What is the interest capping rule? Higher of 30% of beta or 12 million, which will not apply to the natural person, bank, insurance provider, or qualifying project. So this point also we learned today. And again, we are adding over here for the reminding what are the key point we have to keep focus on that.